JSE Safex style options, a great choice.
Welcome back to Wealth and Wisdom. With me tonight is Stephen Brown of Fairtree Capital. He's a hedge fund manager, and we're talking a little bit about global markets at the moment and some trends in the hedge fund industry. So, Stephen, we've got some quite interesting statistics I saw the other day, that only about 11% of hedge fund managers in the States are currently beating the S&P 500 index. Now, that's the lowest it's almost ever been. What do you think are some of the causes of this?
Yeah, it's hard to know exactly what's been going on in the US hedge fund industry without doing some in-depth analysis on it. But one wouldn't expect hedge funds to consistently outperform a long-only index. You know, one has to look at what the return profile of the fund is and what is actually expected to be generated by that portfolio. I think that there's certainly been a lot of concern around protection of capital. Okay. And managers may well have missed the rally in the equity market.
Because they were worried something could go wrong, so they pulled out a bit, sitting on cash, put on options, some sort of hedging in place, not fully participating in this sort of late rally.
Investors are very defensive right now. Portfolio managers are very defensively positioned right now. We are still dealing with an environment of heightened uncertainty. So right now, capital preservation, return of capital as opposed to return on capital has been a far greater theme in the markets.
So do you think with this defensive positioning, I mean, I've heard people talking about it, that there is a bit of a worry in the SA space that guys are maybe overpaying currently for the really defensive stocks. I mean, we're seeing things like SAB, Naspers, Richemont. These guys are trading very, very high multiples. They're really big companies. Is it possible for them to generate the kind of growth to deserve that multiple in the near term?
Yeah.
Is there a risk that in everyone being so defensive, they overbid these assets to the level where the price means it's not that defensive a pick anymore?
Yeah. Look, James, look, the world has changed since 2008, right? And it will change again, okay? But we need to understand what we're dealing with right now. We're dealing with a global environment where there's deleveraging in the system, both by business and by consumers. That is creating an environment where global economic growth is below trend. Okay. Interest rates globally are incredibly low, which is creating support for markets. But while we are deleveraging, you're not going to have strong growth coming through. Okay. Now, the reality is that money needs to find a home. And if you consider where cash yields are right now, if you consider where bond yields are right now, they are incredibly low. So we have a distortion that's going on in your traditional fixed income space, which is going to play out in the equity market.
So these guys are reaching for yield, almost not so concerned about the capital. They're saying, geez, I'm not getting any return on my money market stuff. I want to get some shares that pay decent dividends. I think these guys have the cash flows to do it. I'm going to take that decent 3, 4, 5% yield.
Exactly right. So if you're sitting in the UK, for example, right now, you can go 25 basis points for cash. You can get 1.8% for
0.25% for your return.
Somewhere around
cash.
there. You can get 1.8 for 10-year bond yields, or you can go buy a company like BAT or SAB on a 4.5% dividend yield, which is growing its earnings, compound between 8 and 15. Let's say 8 to 10. So you're going to so those stocks are anything with a dividend yield which is underpinned by stability of an earnings stream is going to remain well bid. Okay. So those strategies are working right now. Yield strategies are working right now. Defensive strategies are working right now because managers just want to know that the company that they're investing with has got a stable earnings stream. And that's going to stay high until the globe changes once again. It may be
the other aspect of that though is inflation. Where does inflation come into it when you're deciding on stocks versus bonds? You've got these yields. Are they safe in bonds?
Well, look, inflation is going to come through into interest rate cycle, and when inflation starts to move, when the interest rate cycle starts to move up, it's going to be an environment where confidence is higher, growth is better, and then we're going to start to see a rotation, and then we'll have a rotation out of defensives back into the cyclicals. Right now, the cyclicals are the value trap. Okay. So managers who are sitting with companies with a highly cyclical earnings stream, although these businesses look incredibly cheap at the moment, you run the risk of sitting with capital which is going to underperform because the earnings of these companies is just not certain.
Okay, so it's that uncertainty. There's a risk of being caught in a value trap, as you call it, which is quite nice terminology. That it's a very cheap stock, but it just stays that way for years, and that's not where you want to be positioned as a fund manager.
Yeah, I think so. I mean, the macro environment is very complex at the moment. Okay, we've got many different moving parts, and if there's any uncertainty of a cyclical earnings stream, managers are going to price the stocks down to low levels, and to levels which were below what we expected a while ago. So what has happened to a lot of managers, or what's potentially happened to managers, is that defensive companies have got to one standard deviation on the high side as far as valuations are concerned, and they sold out into one standard deviation on the low side for cyclical companies, and then that deviation just continued.
It just kept going.
It just kept going.
A lot of the time, a lot of hedge funds are saying, no, this gap's got to close. But in this uncertain environment, it may not necessarily do so.
Exactly right.
It's a bet on uncertainty ending, because that would bring it back. But while there's that uncertainty out there, those more risky players are not attractive.
Yeah, look, we're going to need to see full resolution as far as the European monetary crisis is concerned.
Yep.
We're going to see resolution of growth back in the US. We need to get the fiscal cliff out of the way,
yep.
And we need China to come back to the party. All right. And when that happens, then we're going to have a different environment. If we have growth coming through, rates starting to rise, then we're going to sit in a different world.
It'll be a new world.
Potentially.
Thanks so much for being with us, Stephen.
You're welcome.
Thanks very much for watching Wealth and Wisdom.
Wealth and Wisdom was brought to you by the Johannesburg Stock Exchange.